Hey traders, this tutorial is on mastering the mindset, overcoming trading losses. So I'm Scott Barkley. I'm the founder of ProAct Traders and a trader and a trainer for over 2 decades. Also, I'm the author of the book, The Empowered Forex Trader, Turning Pains into Gains. You can find it on Amazon. And for the last 20 plus years, I've specialized in taking the complex part of trading and making it simple. And that's why I wrote the book, to help traders get it. All right? But I've found significant ways to teach the banker's methodology, which is price action, and making it deceptively easy to understand. But simplicity in a complex environment only works if the trader commits to the process, does the work to gain understanding, and follows a blueprint for success. So mindset means we are dealing with the emotional side of trading. It is our reaction to a win or a loss. Today's session will provide strategies to overcome trading losses through a mindset change. Collectively, the impact of fear and greed and impatience on decision making. Understanding loss aversion and its role in trading, and traders often try to avoid losses at the expense of potential gains. So have you ever done these things? Pulled a stop to avoid a loss. Revenge traded. Thought, I can't take another loss. Brag to your significant other that you won, but kept silent when you took a loss. They know, by the way. These are all responses by your natural brain to risk aversion. Okay, so the key word there is it's a natural response. Okay, so that's going to require that we have to overcome that. So we need to understand how our brain works in the trading world, okay? So the reactions we have when we're taking loss or being in a loss cycle are rooted in the right brain, where fight or flight is ever present. You can see over there on the illustration that the right brain has emotion in it, okay? Oh, it's going against me, man. That's emotion. Or here's one. I think it's going up, man. I think it's going down. That's incorrect. The chart says we're going up. The chart says we're going down. All right. Now, the left brain is the trader. It has logic, analysis, math and science, knowledge and facts, and detail. It does that for breakfast. But most traders are trading on the right brain and do not even activate the left brain. And our Creator created this in us to protect us in a wild world. And in the wild world of trading, we are analyzing our opportunity with the left brain, but as soon as the trade is executed, we are now living on the right side of the brain. Losses, handled correctly, give us the lessons we need to fostering a growth mindset. You either win or you learn. What's a growth mindset? What is the importance of analyzing and learning from trading losses? Answer, it's the only way to learn. Your trading losses teach you what you missed. And by the way, sometimes you didn't miss anything, because the market is going to take 25% of your trades away from you just because it can. Are you keeping a trading journal? Yeah, most people do. And they say, yeah, I made 8 pips on this and it was a win. Okay, that's not a trading journal. You also need to document emotions and thought processes. I thought this was going to do this. It didn't do that. I had it in an up channel and it was really a down channel. And here are my emotions about that. Those things are just as important as your little trading record. In fact, I would say they're more important. What specific questions should a trader ask themselves after a loss? Okay, did I get it wrong? Did I miss something? Did the market take me out? Was there a fundamental announcement that I didn't know anything about because I wasn't paying attention? Those are all examples of things that can happen to us when we're trading and we miss the boat. Right? And the work comes before the trade. Now, most of us don't do that. We go in and where's the trade? Where's the trade? Where's the trade? Instead of analyzing the market to cherry pick the 1 or 2 real opportunities that might present themselves today. And by the way, there are only 1 or 2, occasionally 3, all right, a day, or a session, I should say. All right. So If you have set achievable goals and expectations, then losses are just part of the game. It's like a Major League Baseball player. He's making $30 million and he's hitting 300. What does that mean? That means he only gets a hit 1 out of 3 times he gets up to strike at the ball. All right. So 70% of the time he's failing. All right, but he could make $30 million if he could win 30% of the time. So it's about putting those statistical odds in his favor. All right, so you need to set realistic and measurable trading goals and make sure that you're hitting those goals. Okay, make them pretty simple in the beginning. Just trying to most traders should just try to execute. Did I execute correctly? Not whether the trade won or lost. Did I execute? Did I have a good stop? Did I have a good target? Did I plan the trade? Did I have a bailout place? All those things are part of that, right? So the trader must understand the importance of patience and consistency in achieving long-term success. Now, consistency. For a trader to be consistent, they must find one trade setup that they can consistently recognize, consistently execute on a currency pair that consistently shows that structure and opportunity. Consistently, all right? That's what you're looking for. You're not looking to learn how to trade the whole Forex. It's going to take you years to do that. Could I learn what they're doing today? There you go. Now I could possibly be consistent. Effective risk management in trading. Rules, rules, rules. Rules, by the way, keep you from you. Understand why the rules are there. And if you have no rules, you're not a trader, you are a gambler. They are there to reduce your exposure to a loss. They are there to force you into good habits. They are there to bolster your confidence when a trade has met your rules specification. They are there to reduce emotional pressures from the right brain. Remember, once you execute a trade, you're on the right brain. All right? They are there to counter the 2 most prevalent emotions in trading, fear and greed. Jumping in a trade is FOMO, fear of missing out. And greed is, I know I should take the position off, but I want those 4 extra pips, all right? Those are emotional responses. They are not business decisions. So the impact of fear and greed on decision making is knowing how to execute 1 or 2 trades that consistently are being used in the charts. And you have to have confidence in the left brain's ability to find that opportunity, all right? So that takes work, all right? Assessing real risk and reward, which means you can never scalp. If you do real risk and reward, you will know that you can never scalp for 5, 8, 10 pips. Having a predetermined plan for every trade, including at least 1 place to double your position and a bailout when you realize the trade is not working. Let me tell you about a trader in London I know. He could trade a demo account from $5,000 to $50,000 in a couple of months, all right? He could trade a demo lights out. But as soon as he started trading live money, he lost it all. He gave it away. And he came to me and we were perplexed at first about it. And then I asked him a little bit about his history and he said, well, you know, I grew up, I was a son of a coal miner. Aha. What had happened to him was when he won in the Forex, he was making more money than his father, who died of black lung. He was making more money than his father made in a week he was making in 1 trade. And he psychologically couldn't do it. So how did we solve the problem? We went down to McDonald's and we got one of those little trays, and you know, they put a little paper in there and there's a picture of a Big Mac, a French fry, and a Coke, okay? So we started trading on minis only, and I told him it's not a mini, it's a Big Mac, a French fry, and a Coke. And if you get the end of the day, if you made 20 Big Macs, French fries, and Cokes, that's a great thing. He had to divorce himself from the money psychologically, from the right brain. And guess what? Once he put a different value on it, he ended up being a great trader. Let me tell you about Aldrin, also from London. He contacted me with his last 200 pounds. He'd lost tens of thousands of pounds. And I told him one trade to trade, and he was going to do nothing but that. And not until he got his statistics up. Well, guess what? A month and a half later, he sends me an email. You're not going to believe it. My account is now 2,500 pounds. Fast forward a year and a half, he sends me an email. He now has his own hedge fund. He opened up his own hedge fund, and he's now a full-time trader with his own hedge fund, right? Well, what did he do? He did one trade. Even when he became a hedge fund trader, he still did the same trade, right? So it all comes down to understanding the statistical probability of your methodology. Now, most retail traders use tools and settings and hearsay about a trade that always works. There is no such thing. They have never studied their plan and the tools to know whether it can produce the results you're looking for. Oh, I trade that slow stochastic. Huh? How's that working for you? It's not working very well. Well, what's the statistical probability of it working? I don't know. I heard it was pretty good. That's not a trader. That's still a gamble. If what you're doing can't produce a positive result of at least 80%, pass on that methodology. All right? Well, yeah, but that means I'm going to have to study the methodology to see if it even does 80%. That's right. Be a trader. Traders trade statistics in action. All right? So, since the statistical probability is never 100%, to not have losses is illogical. And a good plan to strive for is 65% wins and 35 plus pip average pip capture. And note, 65% wins means you are losing 35% of the time, which is why your average pip capture must be 35 or more pips, or your losses will eat up your wins. Let's see how this works out in the real world. So there was a broker, Forex Broker Inc., who did a tournament, and at the end of the tournament, some guy won it, and then they went back and took a look at all the accounts and analyzed them. So they took a look at all the losing accounts, and they found out that they were right about the trade 64% of the time. They got it right 64% of the time, but they all lost money. Why? Because their average pip capture was 5.74 pips. In other words, they were scalping. Their losses overcame their wins. Then they took a look at all the winning accounts, and here they are, and they were slightly better at finding a winning trade, 6% better, 70%. But they all made money at the end of the deal because their average pip capture was 36.49. So numbers don't lie, folks. That's the real world right there. So then there's also becoming world-class in 100 hours. You can Google this, the 100-hour rule, how you can become world-class in 100 hours, all right? So what that whole article says is, this is the formula, that if you deliberately practice one thing, skill selection, times 100 hours, you can have world-class skill in that. Okay, what does that mean? Okay, in the Forex, all right, there's lots of pieces to the Forex. So what should I concentrate on? What do they do every day, all right? Well, they do flag patterns and they do pullbacks. So if I could deliberately practice, I mean hundreds and hundreds and hundreds of them, one skill, which is how to trade flags, and I did it for 100 hours, I would have world-class skill. Now, what does that mean? Well, since they do it every day, that means that I can earn while I learn. And then I tackle the next thing. What else do they do? Also, they do pullbacks, okay? If I would deliberately practice hundreds and hundreds of them, nothing but pullbacks, I would find out how to trade them. And if I did it for 100 hours, I could have world-class skill. Now, that means that I could be a world-class trader in only a couple of things, but it's the things they do every day, folks. Don't make this harder. Don't go try to learn a Gartley and a bat and all that sort of stuff. All right, that's the formula. How do I do it? I deconstruct. I take all the stuff that I do and break it down to its components. I'm going to learn how to trade flags. Okay, that's one component, all right? Is that a good thing to do? Well, I'm looking for the 20% of components that give 80% of the value. If they do it every day, that means they do it 99.9% of the time, right? So then I decide on what order to practice in. Well, it might determine on what you see easily, but if you don't see things easily, then practice flags first and then go to pullbacks. Now, what are the consequences or the stakes if you do not follow through? The definition of insanity is to continue doing what you're doing and expect a different result. You won't get a different result. All right, so you have to follow through with this. So if a trader concentrated on understanding just these two things, you could be a world-class trader in flags in 100 hours, and in another 100 hours, you could be a world-class trader in pullbacks. And that's what they do every day. So what's the upside? There's only one way to achieve this, and that is do the work and become world-class in only a couple of things. Press your winners without exception, and trade micros only. That reduces your risk while you have the least amount of education and experience until you start hitting those numbers. Otherwise, you won't last long enough to gain world-class skill. So here's hints to know when to take action. Anytime you're emotional about a trade, you're in danger. Oh man, it's going, no, it's coming back. Oh, I should never made this trade. Oh no. That's right brain. That means you didn't do the work before, you didn't plan the trade, you didn't do any of that sort of stuff, all right? A trade decision is a business decision. It's simple return on investment. If I have to invest my margin and the spread, I should anticipate a return on that. What is that makes realistic? Well, the minimum is 1 to 1, and that's a lousy one. 1 to 2, 1 to 3, 1 to 4. Do you realize that if you could be trading for 3 times, risking 30 pips to make 100, okay, you only have to be 40% right for the rest of your life. You can lose 60% of your trades. Wow, if you'll do it. That's the statistics. That business decision requires that you know the probable outcome if the trade goes right, all right? You have good risk reward for risk built in before you execute. You know the statistical probability of your trade setup in the context of the environment that you have chosen to execute the trade. Okay, I'm gonna do a pullback here because I did 100 hours on that. I'm an expert at it. Okay, well, is this a pullback or is it a reversal? You're the trader. The left brain has to know this is not a reversal. This is a pullback. Yeah, but it's going against you, man. That's the skill. You have not determined a bailout if the trade does not go as planned. You are not facing the prospect of losing from the very start. In other words, if you create a bailout, okay, I'm going to trade this to here, and as long as it doesn't break this slope support, for example, I stay with the trade. All right. If it breaks slope support, I bail on the trade. All right. Now, what have I done? I have realized the possibility of losing right from the start, and I've accepted that risk. That changes your mindset. So we'd love to have you watch us do this in real time in a live room, and just go to proacttraders.com, sign up for a 10-day demo, and you can see traders making hundreds of pips, if not more, doing what this tutorial is all about. And by the way, it's free. Don't forget to like and subscribe us, and hope this helped you. Talk to you soon.